Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
I would agree with you, but then we would both be wrong. My IQ test results came back, and thank goodness, they were negative. Borrow money from a pessimist because they never expect it back. My wallet is like an onion because opening it makes me cry. My email inbox is a graveyard where good intentions go to die.
This is not just a US story. 30-year government yields are rising sharply across the board, with the US above 5.3%, Japan around 4%, France near 4.8%, and Germany approaching 3.7%. The message is clear. Heavy government borrowing, persistent inflation risks, and investors demanding more compensation for lending long term. And when US yields rise, the rest of the world usually feels the pressure. Since the end of 2019, the index is already up 141%. If that pace continues, the 2020s could finish with a roughly 277% gain, making it the second best decade in the S&P 500 history. That would put it ahead of the 257% post-war boom of 1949 to 1959 and just behind the 316% surge of the 1998-99 era. Even the 2010s managed a hefty 190%. So far, the 2020s are proving that Wall Street apparently did not get the memo about slowing down. This works out to roughly $119,700 per American, and the meter is still running at around $181 million a day. The debt has surged by roughly $17 trillion since 2020 and $30 trillion since 2008. The bigger concern isn't simply the size of the number, it's the growing cost of servicing that debt, and the fact that borrowing is becoming a permanent feature of the fiscal equation. Q1 FY27, top-line growth is strong across the board. EMS plus 24%, industrials and infrastructure plus 15%, power plus 9%, and real estate plus 9%. But profits tell a more interesting story. Industrials are up 28%, while cement profits are down 6% despite 8% volume growth. That's a key. The Capex is happening, but costs and margins are deciding who actually benefits. So cables, transmission and distribution, power, and select EMS looks interesting, but this is increasingly a stock picker's Capex cycle, not a rising tide lifts all boats story. Over the last 2 years, the Nifty 50 delivered just 0.3% CAGR. Pretty uninspiring. But move the starting point back 1 year and the picture changes dramatically. Over 3 years, Nifty 50 returned 7.8% CAGR, midcaps 18.2%, smallcaps 17.2%, and SME emerged 16.8%. That tells us something important. The index is not the market. Power, defense, capital goods, manufacturing, and electronics have delivered very different experiences, particularly in midcaps. So before declaring that the markets haven't done anything, perhaps check which market and which businesses you actually own. India's corporate heavyweights are getting seriously large. Reliance leads with $120 billion in revenue, followed by LIC at $110 billion and Indian Oil at $89 billion. Even more interesting is the mix. Energy, banking, insurance, automobiles, and exports continue to dominate the top 10. Reliance now ranks 85th globally by revenue. That's a long way away from being just an Indian success story. The bigger trend is clear. Indian companies are scaling up and increasingly competing on a global stage.